The simplest ideas in personal finance are the most powerful. And the truth is, you don't need to be a slick city trader, have a dozen letters after your name, or a finance degree to make smart money decisions. So in this video, I want to take my 15 years in finance and give you 7 simple, and I mean dead simple, money rules in under 15 minutes. Money decisions that will actually free your life and your choices, not endlessly restrict you. The 50-30-20 rule. What if I told you all you had to do to be really good with money is monitor 4 numbers? That's all, just 4 numbers. I give you the 50-30-20 rule. And it breaks down something like this. 50% of your after-tax income goes towards your needs. Your housing costs, your mortgage, your rent, your groceries, and so on. All the stuff that you don't love to spend your money on, but you have to spend your money on. 30% goes on your wants. This is your guilt-free spending. Money you can spend however you like. Your watches, car payments, dinners out, movie night in, and everything else in between. And this is one of the biggest advantages, really, of the 50-30-20 rule. It breaks the stereotype that people have when you use the word budget. People understandably think of tracking every penny and constantly being told what they can't spend their money on instead of what they actually can spend their money on. And there is so much empirical evidence at this point that people who incorporate spending money on things they actually want to spend their money on are more likely to stick to their own spending rules. And finally, you spend 20% of your after-tax income on your saving and investing. This is you planting acorns today so you can relax in the shade tomorrow. And this is the most important part. This is the part that is so often neglected because the truth is, squirreling money away and watching it accumulate builds your temptation to spend it. Now, this can be simply split as 10% on saving and 10% on investing. We'll come on to the investing part later on in the video because there's a lot to unpack there. And what I really love most about the 50-30-20 rule is it gives you a framework, a great starting point to be able to make real financial progress. It's not super prescriptive about how you spend your money, and it's flexible enough to accommodate most people's circumstances. But knowing you've already put away money for your future in your 20%, you aren't necessarily compromising your financial future because that's a bill you've already paid. It makes spending that 30% so much more guilt-free. It doesn't give you that pang of dread about spending your own money. With the added benefit, you don't have to psychopathically count every single penny you spend, know where it all goes. You just track 4 numbers and make sure you hit your goals, and that's it. But this, it's just the start. It's a good start, no doubt, but it is just the start. So how can we build on this? Pay yourself first. So we've just talked about how the 50-30-20 rule is the bedrock, the foundation of everything we're going to do. But it's not all we should do. How can we build on this? How can we make sure that we have a good framework and then it just doesn't sink into sand? So the next step is to pay yourself first. So let's look at how most people spend their money. They get paid. Maybe they pay their rent or their mortgage so they actually have somewhere to live. They spend money on their wants. Maybe they neglect some of their other needs like a car payment or credit card bill. And then they hope, they pray that they have enough left over at the end of the month to actually put some money away. And frankly, for the most part, it's not that likely that they will. And here's the thing. As humans, we tend to have a need for that immediate satisfaction. In a world of cheap dopamine fixes like social media, buy now, pay later, Deliveroo, and my personal Achilles heel, Amazon Prime, it never has been easier to part with your money. So when you're faced with a decision like whether or not to splurge on a sale or invest money, we are hardwired and biased towards these short-term fixes. But what can we do about this? We can't tell Amazon to go out of business or live in a cave to stop getting Facebook ads, but you can do something very simple. You can pay yourself first. Here's how most people spend their money, as we've just discussed. Paying yourself first looks a little bit like this. You get paid, you pay for your needs, roof over your head, your groceries, and so on, and then you do your saving and investing, your tax-advantaged accounts, ISAs here in the UK, IRAs in the US, and so on, and then you get to spend on your wants. And as we talked about in the last segment, this is so much better because it gives you space to actually spend money on things you want to spend on, knowing that you've already put money away for a rainy day and to fund your financial future self. So I guess maybe we should call it the 50-20-30 budget, but that doesn't quite sound as catchy. But there is a way you can level this up even more, automate your finances. So we've talked about the 50-30-20 budget and paying yourself first. How can you level this up? How can you make sure you don't overspend on your budget and that you pay yourself first? Easiest thing to do is to automate as much of your finances as you possibly can. And that basically has 4 main parts to it. The first is signing up for an auto-enrollment pension. This will probably be the main vehicle that you use to set yourself up for retirement. You get all sorts of tax advantages, so maximizing your contributions that your employer will match is always a good start. Second, automating deposits into your tax-advantaged account. This will come out of your after-tax pay, and by just diverting that money straight into a separate account, you never even see the money to be able to spend it. And this is really the thing that turns you from a sporadic saver into a consistent investor. More on that second part in a moment. Third, get as many of your bills on automated monthly direct debits as possible. Same principle. If you have all your bills paid for, then you're way more likely to keep to your wants at that 30% level that we're aiming for. And lastly, my personal secret weapon on this one, have as many bills as possible come out of your account a couple of days after payday. I get paid on about the 28th, and every single bill within my control comes out on the 1st of the month. So I get paid, all the money goes out, covers my 50% needs, my 20% saving and investing. I can check my bank balance on the 1st of the month, and that money is free and clear. That is my 30% I can spend on once. Free cash to do what I want with. Be boring. The best investments are often the most boring ones. Investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. That was a quote from Paul Samuelson, who won the Nobel Prize for Economics in 1970. And he's basically making the point that investors often make poor decisions when they're driven by adrenaline. And that actually patience is much more likely to produce positive returns in the long run. And he was onto this in the 1970s. And now we have so much evidence that what are called actively managed funds can't beat passively managed funds. So what's the difference between the two? Well, actively managed is where you have a person, and frankly likely a well-paid person, who buys and sells on your behalf in a fund of money that's pooled together. A passive fund is one that tracks a certain index or group of companies. The most widely used passive fund is an index fund, which is a type of investment that simply copies the companies like the FTSE 100 or the S&P 500 and buys a small piece of each one of those companies. It's like buying the entire stock market in one go instead of picking individual stocks. And the evidence shows us time and time again, index funds beat actively managed funds the vast majority of the time. And as Warren Buffett, one of the most successful investors in history, said, by periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. Now, take a look at this paper here to really explain what I mean. Crane and Crotty's research challenges the assumption that an active fund brings superior skill. In fact, index funds often match or exceed the performance of active funds, especially when evaluating risk-adjusted results, consistency, and cost-effectiveness. For most investors, broad-based index funds remain a compelling choice. So, that's the truth of it. You don't need to pay a swish investment manager who will charge you through the nose with fees. And here's the bottom line. Ultimately, the best investments are the ones where you just set it and forget it. Learn how to spend. Now, this is a controversial one, I know. Some people are good at spending money. Some people are a little too good at spending money, if we're totally honest. But very few people are actually good at getting what they actually want from it. And here's the truth. Living below your means is a critical part of building wealth. There's frankly no other way to do it. It doesn't matter how much you make. So it makes sense that when you're going to be parting with your money, you get as much from it as you can. Make sure that 30% of guilt-free spending feels like 50%. And there are 4 main ways you can do that. Trade time for cost. Here's the thing. When you spend money, you are basically attaching a time value to it, not just a cost in pounds, shillings, pence, dollars, rubles, and rupees. You have to trade your time to earn that money, so there is a time cost when you spend it. So make sure you think about that. Marginal cost? Can you spend a little more to get a lot more? It's about what am I getting for the next pound I spend? It's not about the total cost you're spending. Paying for a better accountant? That can pay for itself. Spending £5,000 on some shoes when a pair of Nikes will do fine? Not so much. Next up, opportunity cost. So because you can only spend your money once, every time you do spend it, you forego other things that the money could go towards. Would you rather spend money eating out once a week or take that money and go on a vacation with your family, for example? Want to lease a Porsche? Could you overpay on your mortgage and save thousands in interest? The Porsche will be good fun, no doubt, but it's only going to cost you money. And the last one is maybe the most important one. What if nobody ever saw you? What if you bought a fancy car and nobody ever saw you driving it? Would you still get the same enjoyment out of it? Would you still think of it as being a good purchase? But the bottom line is this. Find the things you like, the things that you feel as though is money well spent, and cut costs aggressively everywhere else in your life. Don't aim for perfection. Aim for consistency above all other things. And frankly, don't beat yourself up. Nobody gets fit by going to the gym once a year for 24 hours straight. They do it by going 2 or 3 times a week, every week, without fail. Be consistent, because time in the market will beat time in the market. One of the biggest advantages is that by maximizing your time in the market, you're going to capture the gains of the market. So look at this. Say you invested $1,000 in the S&P 500 in 1970. Your total return would be $138,908. But if you miss the best performing day, you're down at $124,000. Miss the best 5 days and you're down at $90,000. Miss the best 15 days and you're down at $52,000. And miss the best 25 days and you're down at 33 grand. And this is the thing. The market doesn't make gains evenly from one year to the next, and it certainly doesn't make gains evenly from one day to the next. So if you try and time the market, you run the risk of missing out on those big days when the gains are outweighted. By maximizing your time in the market, it just means you can be there for the upswings, but it also means you have more time to recover. Focus on the right things. Right at the start of the video, I talked about how in the personal finance world, there is a cottage industry, practically a cliche of don't buy coffee, that's why you're broke. Don't buy avocado on toast, that's why you can't afford a house. Now, clearly, it doesn't need to be said, but I'll say it anyway. That's all nonsense. Because here's the thing. People spend a disproportionate amount of time on the small things that will only make a small difference in their finances. Shopping around for cheap places to fill up your car with petrol, coupons, making your own coffee, and all that sort of thing. But here's the thing. If you can find a way to increase your saving and investing rate by even 0.5% every single year, I guarantee that is going to have way more of an impact on your finances than giving up coffee. That will buy you all the coffee you could ever drink in several lifetimes. So focus on the stuff that is really going to move the needle with your finances first. And sure, after you've done all those things, then cut out the coffee, but don't start with the coffee. Now, we have 4 videos on screen, which will all be absolutely critical in helping you in your next step. We have this video here on how to spend money, this video here about 17 pension mistakes everyone is making, and this video here about 40 harsh money truths I wish I'd known in my 20s. And finally, this video here about wealth killers that nobody is talking about. You've been watching Modern Money Talk. Thanks very much for watching. Please like and subscribe if you like this video.